This is Short Hammer. It is the 3rd of November, 2019, and we are looking at Amazon on the 4-hour chart. Now, what's really interesting about the levels that we are on Amazon is we're at those 1792, 1798, and 1805 supply demand line levels, which are significant supply areas. You could call it a bad neighborhood. We have to go through this bad neighborhood to really get to the upper levels where we have a little bit more space to operate, I would say. So if we look back, when Amazon, since we've fallen below the 1790s, when it's gotten back up into those levels, the supply has overwhelmed demand and pushed us back down. And this line is a longer term downtrend line from July, or the last earnings period, or actually a little bit before that. So what we want to look for here is, what do we do when we push back up into the 1790s and 1805 area? And since, I would say, September 20th or so, each time we've been in this area, we've just pushed down and down, went back to it and down, approached it, down, tried again, down. Now we're here again, and can we get through this 1805? So the last time that we were, let's see, go back, because this is interesting. And I'll try to make this as quick as possible. So this was last earnings. This was on July 25th. And of course, Amazon dropped from there. And we see the selling that took us all the way down and pushed us into these like 1717. I think 1717 is where we went to. And what's interesting about that is, for about a month or so, we were stuck between roughly the 1747s, that's the bottom of the channel that I have, and the 1830s, or roughly 1833s. And 1756 is an important supply demand line within this channel, but I like to use the 1747 area just for clarity. So we sort of bounced around here. Buyer stepped in, and we see the first back test of the 1805-ish area, and we rejected, pushed back down, and the push back up into it. And we kind of struggled a little bit for a few days, but eventually buyers got us through, and we ran right into this 1833 area, tapped it for 2 days roughly, went back down, back tested, tried to get back up there, and the selling ensued, and tried to push back, and down we go, right down to the 1770s, back up, trying to get through again, then back down even lower, test the 1747, buyer stepped in again. So you see, we're kind of in this channel. We get above here, and the thought process was maybe we'd see some buying pressure to take us above this supply demand zone here. Sellers kind of pushed us back down, and we're holding now using the 1790s by 1805 as demand. Buyers are trying to now get us out of here and above this supply demand zone. Can't do it. You see the weakness here as the sellers are taking control. And then the push down here, buyers stepped in again with the intention of, hey, let's run this back up right into this 1790s by 1805 area. Sellers step in. And that's where we find ourselves today. So we do have a lower channel that's like 1746, 1745-ish by 1705 on Amazon also. But that's not important for the purposes of what we're discussing today. And let's look at the lower time frame. But this is just an interesting peek as we've broken this longer term downtrend. And we have to see if there is a break of the 1798 and 1805 and a squeeze. We'll have to see. Or if the selling steps in and it pushes us back down again from the 1792 by 1805 area, and we matriculate back down near the 1756 and maybe lower. So we have to see. There is a bit of news that came out this weekend that may or may not be consequential. We have to see that China did win their case at the WTO, World Trade Organization, against the United States. And they have the ability to, I believe, impose tariffs of up to 3.5 billion. I may be off on that, so you probably want to do a little bit of research and dig into that to see how consequential that may be. It could be a nothing burger. You never know with news. News can be funny, but we'll see where that takes us as far as Sunday with the futures, and then Monday during the cash session, how the market reacts to the potential of what China may do with that new information. So let's look at the lower time frame. That will be the 5-minute chart. Let's take a peek at that. So on the 5-minute chart, what we'd want to see is, so this is Friday and this was Thursday. So on Thursday, we pushed up near the 1792 and the buying pressure just faded, and you see the sellers kind of took control of this bad boy and took us all the way from the 1792-ish area down to 1772. That's a nice drop. And right here near the main intraday pivot and also the 200 SMA, we found buyers, pushed us back up, and we kind of matriculated around this area, headed into the close, sort of right below it at the close. But overnight, we saw this pop and this push to the upside. So what we would have been watching for on the open is, can we get past the previous day's high? And what can we do with the pre-market high, which was here around the 1788 area? So at the open, we flared down, tested the 1785, which is the line we had in place for a few days. I believe on Wednesday it was a after hours level that we drew in that we really liked, and we had a flare down near that level, and buyers stepped in, pushed us back up. We back tested the, I'll say, pre-market highs here, along with pushing through the highs from Thursday. And then the buyer stepped in and gave us the squeeze. Now, if you wanted the first entry, potential entry here, if you wanted to be a little bit risky, was this 1785 flare down. The second was the back test of this pre-market high area. And I wouldn't take either. Out of these two trades, the one I'd probably take would be this flare down, but I'd still be hesitant to take that because I would really be looking at market trend, which is kind of hard at the open to see the direction that we're going because it can reverse so quickly on you. So I probably wouldn't take this trade, and I probably wouldn't take this trade either. But I'll just be watching for the break above the 1792s and seeing, do we see more bullish candle formations, which we do. But I'll be leery to get long because I see the 1798s right here, then the 1805. So I'd really be watching this area. So when we pull back here, I have two options. If we pull back to the 1792, which is the previous day's high roughly, and also supply demand line, I can choose to go ahead and get long here if I feel the market is trending bullish and I see significant buying pressure off the 1792 for a retrace to either the high of day or pushing to the 1798 and a potential break. That's one play. But looking at these candles, I wouldn't take that play. It just seems a little bit too risky. The next play would be a failure of the 1792 to hold, which would open up a pullback to the 1788, the pre-market highs, and also the 1785, which is a line that we have drawn from a previous session. So this fade would be probably the first trade I would take if I was just really unsure of the day and unsure of the trend. And we were really running during the day. So the SPX was running the market. We definitely were pushing up. But just seeing this weakness would have given me a little bit of pause, because it would seem as if Amazon and maybe the market may not exactly be in sync. And then we see this sell here, and we could have written this down. Now, if you had multiple contracts, and I'll make this fast. If you had multiple contracts, if you faded this area here, or you got short on the break below this, and then the retest here, or depending on if it opened up here or what happened on this candle. But if you got in on this push up here, your stop would need to be up here above 1793.45. And so that's about $2 to $3 would need to be your stop, because you'd be waiting for a break back above this 1792 and bullish candle formations for you to get out. But your stop would be a close above 1793 if it was just one single candle and the next candle opened up above that. That's where you'd be out. That's, well, for me, that's where I'd be out. And so as you're going down, if you're in multiple contracts, I'll take out half at the first interaction with this line, see this pullback, and I'll wait to see if we made a higher high here or higher low, which we did. We made a lower low and a lower high. And we spill down to the 1785 area, where I'd exit another 25% minimum of my contracts, if not more. And my stop would be a pullback and any bullish candle formations up here around this 1788 area. That was a prior level, pre-market highs, back test hold. So we'd be watching that pullback here for scaling out of the rest. And so that's an option. Or you can exit, if you're in one contract, you can exit all here, or be a little bit risky and see if it'd go to the next level. But for me, I'm usually getting out of my contract or contracts, depending on the first interaction with resistance to my move. That's where I'm scaling out some, or I'm scaling out all. So the next, I'll say, thing that we can do here is watch this yellow line here is the VWAP. So we could have taken a VWAP fade on the pushback up and used the VWAP as a break above and bullish candle formations above the VWAP and push through 1792 as our stop. Totally different setup, but that's something that we could have done for a retrace to test the low a day, which is around this 1785. And so as we approach the 1785s, I would be getting out my contracts. Like, I will be out. Like, I would just be scaling out, and I'll probably be out 50 to 75% here. And any signs of strength, I'm out. Just because earlier in the day, we reached this area and we found buyers. There was demand there. So what would make me think on the retest of that area that those buyers wouldn't still be there? There's a strong potential that those buyers are still there. So at this level, I need to scale out the majority of my contracts, if not all of my contracts, and wait. Then if we broke below this and back tested, and there was weakness down through here, then yes, I can get short again and maybe take it to the 1780 area, and maybe even take it down to 1777. We have to see. But that's how I would be playing Amazon. Now, going into Monday, the main intraday pivot is at 1791, but I'm really going to be watching the 1792, 1798, and 1805 area, and also these lower levels of 1785. This 1777, and a few of these lower levels down through the 1760s for a potential retracement if there's weakness in the market. If there's strength, I'm watching for a break of these previous day levels, 1798s, maybe to the 1805s, to be able to ride the wave up to the top of the channel, maybe the 1833 area, 1830s. So that's what I'm planning on Amazon, and that's what I'll be watching for on Amazon. Amazon is definitely a big mover, but don't be intimidated. You can choose to play a little bit out of the money. They can be funny on the repricing sometimes, but it's the most technically sound stock that I trade, and I really love the movements within Amazon. So if you have never traded Amazon before and you're now interested in checking it out, I would recommend paper trading this on Thinkorswim first, so you can find your strategy and your style that you like within Amazon. according to its daily movements. And it's a really good stocks trade. But that's my thought on Amazon and what I'll be watching for going into next week. And we'll see, because we're entering November. Black Friday is coming up. It's just a holiday season where Amazon usually does well. And they did guide down, which is a slight setup heading into the holiday season, because you know they're going to beat big. So we'll see. They cited that their investment in their own delivery / transportation network has been one of the biggest reasons or biggest cash draws from the company. But we'll see how all this plays out, because I'm just watching for the day-to-day plays. So we'll see how this plays out. But I'll keep an eye on Amazon and watch the levels that we mentioned for potential retracement or buying pressure to push us up and for us to get to some higher levels here, getting through these 1805s.